Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds in Melbourne, and this is a review of markets in 2023. Markets got off to a great start opening up in January, buoyed by a little bit more certainty about central bank pathways. There are some more rate hikes to occur in the first quarter of this year, but thereafter, central bankers have alluded to more data dependency right across the globe. Starting in Canada, we've seen similar commentary from the US Federal Reserve, the ECB, and the RBA is certainly expected to follow suit. Obviously, the burden of proof to continue to raise interest rates after such an aggressive interest rate cycle becomes much, much harder, with a very known lag effect through to the economy that will clearly curtail economic activity in time as the cost of capital the world over has gone up quite materially. And certainly for anybody with a mortgage, they're experiencing right now that mortgage rates have really ratcheted higher, and they're taking away a lot of discretionary income for many folks, which clearly has a big impact in that part of the economy. The data that we've seen so far has been pretty ordinary employment in many places. So if we look at US data, for instance, as the kind of barometer for global economic health, just if we run through a few of the data prints in January, ISM numbers are below 50. That is in contractionary territory. New York Fed, Richmond, Philly Fed, all deeply negative below zero, very contractionary. Even Dallas included in that. Industrial production negative, manufacturing production negative, retail sales quite negative. And this is a similar picture broadly across much of the developed world. We're seeing similar outcomes in the United Kingdom, similar in Germany. In Australia, we had a very large negative retail sales number here in December. But as I said earlier, the employment side of things is still holding up, and employment is a classic lag indicator, I guess, in the economy. So there is a lot of contention about is what kind of landing this might be. Is this a soft landing? Can this be engineered to that place? And certainly in central bankers slowing down and moving to a period of pause and assess will be much more helpful for economies to settle, and we'll really get a better understanding of trend will evolve. As we've mentioned many times, here, the transmission mechanism in Australia is much higher, i.e. the variability of most of our personal debt and certainly the mortgage cliff which we face into 2023 and 2024 is incredibly pronounced. Fixed rate mortgages, if you were lucky enough to have one at 2%, are now resetting into 5.5%. On $1 million mortgage, that's $20,000 a year to $55,000 after tax. That is one hell of a loss of discretionary spend for many households. Obviously, not everybody has $1 million mortgage, but just to keep the numbers nice and round and easy, some people have bigger mortgages, some smaller, of course. But the outcome is the same throughout the economy. But Australia starts, again, from a position of rude health. The reopening of China and some of these things certainly buoying, the story here, and particularly around, the Aussie equity space, which has been doing really, really well. It's our expectation that bonds, after a terrible year in 2022, will do a lot better. We have put out plenty of scenario analysis looking at just the mathematics of bond indexes. If you'd like a copy of that, please contact us directly or one of the Channel Capital sales folks. There's some really interesting data in and around that, looking at different scenarios as to where will inflation land once it finds trend. Obviously, it has a huge amount of amplitude. After being very, very high, the amplitude allows it to fall very quickly, and we're seeing inflation rates the world over starting to fall quite considerably. And that will continue to occur as the base effect rotates. But then later on at some point, they will turn up again. And we're going to find that it is going to be quite a choppy series until we find that long-term trend in a post-pandemic world, in a world that faces much more geopolitical uncertainty, and in a world that really, that energy componentry is such a big swing factor. What will happen to that? Can Biden continue to release strategic petroleum reserve barrels and curtail the price of energy that's done very, very spectacularly well since the start of the Russian-Ukraine war, when oil got to about $130 a barrel, as we're recording today, about $75 a barrel. But the expectation, I guess, is with the reopening of China, the inability to continue to manipulate that market using the strategic petroleum reserve, then there could be a rise in energy prices, certainly into the middle or later in the year, which can have a big impact on inflation. This is really important as it pertains to how quickly can central banks turn around and support economies if they continue to weaken, as most people expect that they will. In other episodes, as soon as the economy has become problematic, we've had rate cuts and quantitative easing. If inflation is still proving to be problematic, that will not be easily achieved. It would only accelerate inflation, thereby undoing the very thing that they've been fighting for the last 12-month period, certainly across 2022. And this really matters as it pertains to the cost of capital and what will happen to some of these asset classes that have been so heavily supported under a there is no alternative world and a zero cash rate world that become very violently affected, particularly in terms of liquidity and credit quality as credit delinquency continues to build. To have credit delinquency, we need the price of money to be high. Well, it's a lot higher than it has been, but we also need it to stay there for a while. If it just shoots up and comes down again, then there is obviously a bridge to the other side. If it shoots up and stays up, then it starts to really squeeze, particularly, and we've spoken a lot about this, as corporates go to refinance existing debt obligations. You'll see this in property markets where property developers will not be able to secure funding to continue to keep going, and therefore they get washed out. And this is just classic cycle dynamics, but it does take time. As we open 2023, markets are loving the fact that bad news, certainly on some of the economic data front, is good news and probably brings us to a point where central bankers are no longer, meddling with the interest rate settings constantly. We might find that pause and settle. And the employment picture is suggesting that economies are still growing. We had big seasonal adjustments in the US employment numbers, but notwithstanding, they were incredibly impressive at the end of the January data series. So I do expect and encourage you to reach out, get some of that scenario analysis, have a think about the impact on different asset classes over the course of this year. Bonds, clearly, after a big sell-off, they are a very self-rebalancing asset. Yields are as high as they've been in many, many years, and index carry and rolls very, very powerful. So it's our expectation that they will do very well in an asset class relative sense. And certainly, given that we have a lot of uncertainty still in markets, it's really important to think that through. Just on that front, the expectation of uncertainty around inflation outcomes is obviously falling very, very quickly, but it's now replaced by the uncertainty around growth outcomes. That's a lot easier to model. Obviously, the uncertainty around inflation, it's very difficult to know where things will settle, particularly as, what rate will central bankers need to achieve to kill and slay the inflation beast? Where will bond markets settle in regard to that? The growth uncertainty is a lot easier for us to forecast. So we do expect that bond market volatility will be a lot lower this year over the course of the year, where it was very high last year. And that's really good for a number of things. It's not good when the risk-free asset is moving around constantly. It makes it very difficult for all asset classes to really price with confidence. And certainly in that much higher volatility setting, we did see smaller, risk appetites in many asset classes, slightly less liquidity, that type of thing, because of that uncertainty. So as that volatility drops, we will expect that things like value at risk models and the like can probably risk up again a little bit, risk parity strategies, these types of things. So we will get markets that behaving a little bit more like we will have experienced them previously, whereas 2022 was just such an extraordinary year in many, many aspects. We look forward to having this conversation with all of you across 2023, answering any macro concerns, talking bond markets. We do encourage you to reach out if you do have any questions. And we certainly wish you all the best on your investment journey this year. Thank you very much.